You're watching today's market comment by Haralambos Pisuros. I'm Christina Marujas, and thank you for joining us at XM.com. The US dollar continued gaining ground against all its major counterparts on Tuesday as risk appetite continued to deteriorate on the back of disappointing Chinese trade data, but also after Moody's cut credit ratings of several small and mid-sized US commercial banks late on Monday and said that it may downgrade some of the nation's bigger lenders as well. Concerns about the performance of the world's second-largest economy and renewed uneasiness about the credit strength of the U.S. banking sector have prompted investors to seek safety, abandoning risk-linked assets and preferring safe havens like the dollar. In an unusual fashion, Treasury yields moved in the opposite direction to that of the greenback yesterday, suggesting that U.S. government bonds may have also been considered a safety choice, despite last week's sovereign downgrade by Fitch. It could also be that with 10-year yields hovering above 4%, U.S. bonds are becoming even more attractive. That said, following the U.S. Treasury's pledge to increase its debt issuance, the current retreat in yields may prove to be limited and short-lived. What could add further fuel to the dollar's recovery and help yields rebound is Thursday's U.S. CPI inflation report for July. The headline rate is expected to have increased to 3.3% year-on-year, but the core one is seen ticking down at 4.7% year-on-year. The dollar is losing some ground today, perhaps as euro-dollar traders retested the important uptrend line drawn from the low of September 26th. The pair could continue hovering around there, waiting for tomorrow's data. On Wall Street, all three of its main indices closed in the red yesterday, staying in correction mode. That correction could extend on Thursday if the CPIs reveal that inflation in the United States is stickier than previously thought, as market participants may reconsider the possibility of a September hike by the Fed and perhaps scale back their rate cut bets for 2024. Despite the reduced risk appetite, oil prices managed to rebound yesterday. The latest recovery is mainly driven by the pledge of major producers like Saudi Arabia and Russia to keep supply subdued for another month. But for the outlook to become brighter, WTI may need to overcome the key obstacle of 83.30, which has been acting as a ceiling since November 2022. This was today's market comment here at XM.com.